Gold has officially breached the $5,000 mark, printing $5,012 in the overnight session as I record this. And while the mainstream financial media is scrambling to find adjectives to describe this move, the real story isn't the gold price itself, but what it is, screaming about the death of the current monetary system and the imminent explosion in silver that is now knocking on the door of $100. This isn't hype. This is the market finally admitting what we have been tracking here for months. The disconnect between physical reality and paper suppression has become so wide that it can no longer be contained by algorithmic trading or coordinated shorting. And if you're watching this on February 14th, 2026, waking up to these headlines, you need to understand exactly why this is happening and why the next 48 hours are absolutely critical for silver. Let's cut through the noise immediately because the data points we saw come across the terminal late last night, US time, are staggering, and they confirm a thesis that many thought was impossible just 6 months ago. Gold didn't just inch past 5,000. It did so on the back of a massive liquidity injection that we saw hints of in the repo market earlier this week, combined with a catastrophic failure in the treasury market that traditional outlets are barely touching. We saw the 10-year yield spike to 5.5% even as gold rallied, which fundamentally breaks the traditional inverse correlation script that every textbook economist relies on, telling us that this isn't just an inflation trade. This is a trust collapse. When bonds and the dollar sell off simultaneously while gold goes vertical, you are witnessing capital fleeing the system entirely, not just rotating sectors. And that capital is looking for the only exit that doesn't have counterparty risk, which is physical metal. Now, here is the connection that most analysts are missing because they are too busy celebrating the gold number. And this is where the silver setup becomes undeniable. The gold to silver ratio, which has been artificially suppressed and held at extreme highs for years to mask the monetary instability, just collapsed from 90 to 1 down to 50 to 1 in a matter of weeks. For silver to be trading at $92 an ounce, while gold sits at 5,000 implies that the market is beginning to price in the monetary remonetization of silver, not just its industrial utility. We are seeing the Shanghai Futures Exchange open this morning with premiums that are absolutely breaking the Conx pricing model with physical silver trading at a $14 premium to Western paper prices. A gap that is untenable and signals that the Eastern physical markets are no longer accepting the Western paper price discovery mechanism as legitimate. I need you to really listen to this next part because this is the specific data point that changes everything for the delivery month we are entering. We just got the latest COMEX Vault report late yesterday, and registered silver ounces available for delivery have dropped below the 50 million ounce mark for the first time in history. We are looking at 48 million ounces of registered category silver backing, over 320 million ounces of paper, open interest standing for delivery in the upcoming contract month. That is a coverage ratio of nearly 7 to 1. And it is the sort of fundamental insolvency that would shut down any other market instantly. Yet here we are watching the regulators stay silent while the banks try to frantically roll contracts forward to avoid a default. The problem they face now is that the longs are not rolling. We saw JP Morgan and a few other bullion banks try to offer cash settlements at a 3% premium to the spot price yesterday to discourage physical delivery, and the longs rejected it, demanding the metal instead. That rejection is the spark that lights the fuse for the $100 silver target. Here is the technical landscape that we are navigating right now and why the setup is so explosive for those of you watching the charts. Silver closed the US session at 92.40, but more importantly, it broke out of a multi-dead cup and handle pattern on the weekly time frame with extreme volume. We are seeing volume profiles on the CME that exceed anything we saw during the run-up to $50 back in 2011, indicating that this is not retail speculation, but institutional accumulation. The next major resistance level isn't until $14, which was the inflation-adjusted high from 1980. But between here and there lies the psychological $100 mark. And once that falls, we enter price discovery territory where there is no historical overhead resistance to guide us. The algorithms are currently trying to pin the price below $95. But every time they sell into the bid, we are seeing the bid stack replenish instantly, which tells you the buyers are aggressive and they are waiting for this paper manipulation to fail. Now, let's talk about the geopolitical chessboard because this gold breach is directly tied to the events we discussed in the last video regarding the BRICS settlement layer. Just 48 hours ago, the BRICS coalition officially announced the launch of their new settlement unit unbacked by any Western currency and settled 40% in gold and 60% in a basket of local currencies. This is the moment the dollar hegemony ended, not with a bang in the news cycle, but with a quiet shift in how trade is settled between the global south. The moment that announcement hit the wires, we saw central bank buying in the London over-the-counter market go vertical. Sovereign entities are not selling gold at 5,000. They are buying it because they know that under the new settlement rules, gold is the only asset that bridges the trust gap between nations. Russia and China have effectively created a floor under the gold price that the Western central banks cannot break without dumping their own reserves, which would destroy their own balance sheets. This is checkmate on the monetary board, and silver is the byproduct of this trap position. For those of you who are new to this channel, I want to be very clear about what we do here. I do not sell signals, I do not offer managed accounts, and I will never ask you for money. If anyone in the comments is claiming to be me and offering financial advice, report them immediately because I am only here to provide financial warfare education, to show you the raw data from the exchanges, the vault reports, and the commitment of traders' data that the mainstream ignores. My handle is OG John AG on X and YouTube, and that is the only place I post. If this analysis is giving you clarity and helping you verify the reality of the markets we are in, drop a comment below with OG John AG so I know who is actually paying attention and doing the work versus who is just scrolling for hype. Your engagement tells me that this unfiltered approach is resonating and it helps this channel grow without compromising the truth. Let's circle back to the physical market dynamics because the disparity between what you see on a trading screen and what is happening on the ground is now at a breaking point. Dealers across North America and Europe are reporting zero inventory for immediate delivery on most silver products. Premiums on physical coins and bars are now exceeding 25% over the spot price, which is essentially the market telling you that the spot price is a lie. If silver was truly $92, you would be able to buy it for $95, not $120. This bifurcation between the paper price and the physical price is the single most important indicator for the coming explosion. We are seeing large wholesalers offering to buy back allocated holdings at spot plus 10% just to source metal to satisfy industrial demand, which is soaring due to the solar and EV sectors that cannot substitute silver out of their supply chains. This industrial offtake provides a hard floor while the monetary demand provides the ceiling breaker. I want to address the bearish case because discipline requires looking at both sides, and blindly hoping for a moonshot is how you get wrecked by volatility. The bearish argument right now relies on a liquidity event. A sudden freeze in credit markets that forces leveraged funds to liquidate everything including gold and silver to raise cash for margin calls. If the equity market cracks further and we see a circuit breaker halt on the S&P 500, we could see a sharp, violent correction in metals as algorithms liquidate positions indiscriminately. Silver could retest the $80 level in a flash crash scenario if leverage is flushed out. However, here is why that bearish case is weaker now than it was in previous years. The physical squeeze is real. In previous crashes, there was always physical metal available to deliver, so the paper price could be slammed with impunity. Today, with vaults empty and premium spiking, any significant paper slam will result in an immediate arbitrage, where physical buyers vacuum up the discounted paper and stand for delivery, accelerating the default scenario. They cannot crash the price without breaking the exchange, so the downside is capped by physical reality. Here is the macro catalyst that everyone is ignoring because of the gold headlines. The US CPI data released yesterday showed inflation re-accelerating to 6% despite the supposed cooling measures. This puts the Federal Reserve in a box that has no exit. They cannot raise rates significantly to fight inflation without imploding the banking sector, which is already sitting on massive unrealized losses in their treasury portfolios. And they cannot cut rates without sending inflation hyperbolic. They are trapped, and the market knows it. The DXY index is hovering at 92. And the moment it breaks below 90, we will see a flood of foreign capital entering the metals market, not for profit, but for survival. When you combine this macro trap with the supply deficit in silver, which is now in its fourth consecutive year of structural deficit, you have a coiled spring that is ready to unleash energy that most traders cannot comprehend. The only variable left is timing, and the breach of $5,000 gold suggests the timing mechanism has now triggered. Looking ahead to the next week, we have the President's Day holiday in the US on Monday, meaning US markets are closed, but Eastern markets will be open. This is the classic window where manipulation thrives, because the Western physical market is on holiday, while the paper market algorithms are left to run wild or be exploited by thin liquidity. We saw this pattern in previous years, and I expect the banks to try one last stand to defend the $100 silver line while US traders are away. Do not be surprised if we see a vicious paper raid on Sunday night or Monday morning in the futures market. However, if silver holds its ground and the Shanghai premium remains elevated during this US holiday window, that is the final confirmation that the control has shifted permanently to the physical buyers in the East. Watch the Shanghai close on Monday very closely. If they close at a premium of $10 or more, the follow-through when the US reopens on Tuesday will be explosive. We also need to talk about the mining sector because for the first time in a decade, the miners are starting to outperform the metal. The GDX index is up 15% this week alone, signaling that capital is moving down the risk curve into the producers who are sitting on massive profit margins at these gold and silver prices. If silver breaks $100, the profit margins for primary silver miners go from barely break even to astronomical, and that capital rotation will act as a leveraged bet on the metal itself. This is often a lagging indicator that confirms a bull market is not just real, but sustainable. As smart money moves from buying the metal itself to buying the companies that pull it out of the ground, it is another data point in a long list of confirmations that this move has legs and is not a blow-off top. The question I get asked most often is, John, when do I sell? And the answer requires a shift in mindset. We are not trading a cycle. We are navigating a regime change. If $5,000 gold is the new floor, selling your silver at $100 might be the equivalent of selling gold at $400 back in 2005. You don't trade a monetary reset. You position for it and let the chaos play out. I'm not selling a single ounce of physical until the gold to silver ratio returns to its historical average of 16 to 1, which would imply silver prices significantly higher than where we are today, or until the monetary system resets with a new currency architecture that restores confidence. We are miles away from that right now. The trust deficit is widening. The debt spiral is accelerating and the political instability is growing globally. To wrap this up, we are witnessing history in real time. The breach of $5,000 gold is the signal flare that the old system is dead, and the race into tangible assets has gone mainstream. Silver at $100 is no longer a if a question. It is a when question, and the data suggests the when is measured in days or weeks, not years. The manipulation tools are blunt, the inventories are empty, and the geopolitical shift is undeniable. Stay disciplined. Watch the COMEX's Vault reports. Track the Shanghai premiums and ignore the noise. This is financial warfare, and your best defense is knowledge and physical metal. OG out and about.